Hey everybody, we're back again. Time for Advanced Options Strategies. My name is Brent Moores. Glad to be here with you. Also, I'm joined alongside Barb Armstrong, who's helping me on the chat today. Always appreciate Barb. And encourage you to check out her webcasts, including Trading a Smaller Account webcast. Great webcast. And also she has a Getting Started with Technical Analysis webcast now too. So make sure you check that out as well. Invite you to follow both of us on X at Brent Moores CS, at Barb Armstrong CS. And you know what? I don't appreciate just not just Barb being here, but I appreciate you being here too. Taking some time out of your schedule, whether you're watching live or on a recording, that's great too. Before we get to our subject today, which I'll tell you about in just one sec, but let me just mention this. We're going to be talking about options today, of course. And they do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It's not a recommendation of any security strategy or chart type. Schwab does not recommend the use of technical analysis as the sole means of investment research. Paper money application is for educational purposes only. For the sake of simplicity, the examples I'm going to use, I may not factor in commissions on all those, but that is an important thing to think about. All investing involves risk, including risk of loss. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And I don't know. That's, that you guys have heard a lot of this before. There's no guarantee of an execution of a stop order is going to be at or near the stop price. All right. So earnings season is in full force at this point. And that's great. We see this each day. But I'll tell you what, next week is a power-packed earnings week, so to speak. And I want to talk about two types of potential strategies you may consider as we are encounter these earnings. One of those is a long straddle and one's a short straddle. Different forecasts for those stocks there. So that's kind of where I want to start. I want to talk to you about earnings season, where you can see what's coming out with earnings. Talked about long straddles and short straddles, and that's the main thing here today. So let's start off, if you will. Let's just take a look at that earnings calendar because I think it's significant. I'm going to go to the Market Watch tab. I'm on the Thinkorswim desktop platform, and I'm just looking at the S&P 100. Now, of course, you can view every stock out there if you want. There's a lot of stocks out there. You may not want to. You can narrow it down to the S&P 500 or some other list. S&P 100 tends to be pretty liquid in terms of options for the most part. Of course, you got to double check them individually because not all options on all these stocks are liquid, even when you narrow it down to the S&P 100. But it's a pretty good starting point. And what's today? Today's the 24th. So let's go on. Today, we had Verizon this morning. But let's look at next week and see what we got. American Express, AT&T, Boeing, General Motors. Look, there's a lot of companies, including a few that you may have even heard of: Meta, Microsoft, Tesla, Caterpillar, Comcast, MasterCard, Altria, UPS, Apple, little company called Apple. So that's all next week. So next week a lot of times we look at different things in terms of what can affect the market. I think the name of the game next week, for the most part, is probably going to be earnings. How do these earnings come out? That's significant for the market. But when you look at these individual stocks, you may decide, hey, I want to speculate. And this is really in the realm of speculation, folks. Here on terms of what our stock is going to do on earnings, because ultimately we just don't really know what a stock is going to do. Let me just do this. I'm going to bring up Meta to start us off, and because I want to look at a few things here. So here's Meta, and you can see what the stock has been doing. But here's what I want to do. I want to show you. Let's go to implied volatility on Meta, and let me go to a little bit of a longer time frame on here. Let me go to a 5-year chart maybe. And I'm just going to zoom in a little bit, though. I don't want a full 5-year. But what I want you to notice is, in terms of our implied volatility, this is, it goes up, and down and up and down and up and down. Well, if you look closely, what you're going to see is it tends to go down when the earnings comes out. Earnings comes out, tends to go down, etc. I won't point them all out, but just realize that is typically what happens in earnings, because going into earnings, there's more expectation of bigger moves for that stock. And so options get more expensive. And then you have the earnings event, some of the uncertainty gets taken out of the market, and those implied volatilities go down, and option prices, everything else being equal, tend to lower. They lower because of the implied volatility. But no, if the stock goes way up, it doesn't mean that call option may not go up in price. Or if the stock goes way down, that put option may go way down in price, even though the implied volatility is dropping. So just be aware of that. That I think a lot of you know, and I don't want to belabor that too long here. So let me get out of this, and let me just point out a couple other things on Meta, or any stock that you're looking at in terms of earnings. One thing that you can do on this is, as you're trying to anticipate what earnings are going to do, is you can go to the Analyze tab. You can go to the Earnings sub-tab. If I'm not mistaken, this tab here is not available on Paper Money, only on your live platform there. Okay, so this Earnings tab, but I may be wrong on that. That's how it used to be, I think. But you can see some information here. You can go through the past earnings, and you can see what the stock price did before and after earnings. Here we're going back to Q4 of 2022. Went from 153 up to 187. Nice jump here. Okay, went from 298 to 311. Right, and so you can go through and you can see how the stock reacted. Of course, you can do the same thing on just looking at the stock chart if you want, to get a sense for how much of a move that you may see in this company. Now, there's other ways to do it, and I'm going to show you that in just a little bit. You can also see what happened to implied volatilities along the way. You can see where the at-the-money straddle price is in terms of expecting in terms of a percentage move on that stock. Here, the market expected about a 9% move on the stock going into earnings. It expected about, again, a 9% move going into earnings. On this one, well, about 9%. It's been pretty consistent on this in terms of what it's been doing there for Meta. They're not always exactly the same. There's 6%, and so a lot of this is actually more consistent than most stocks in terms of the expected move there, in terms of that at-the-money straddle price. I'll show you how to find that as well. And then finally, on this page, you can see the earnings per share of the company for each of these earnings events, how it came out. That's the yellow line. And here's the green line, which is what the expectations are. Now, one thing you may not be aware of, or may be surprising you, you go, well, look, Meta, wow, what a rock star. They beat on earnings here, expectation versus, and they beat here, and they beat here, and they beat here, and they beat, wow, amazing. Well, I'll tell you what, most companies beat most of the time. Now, it's not to say that companies beat all the time, and it's not to say that Meta is going to beat each time, but you can't just say, well, if they beat, they're going to, they've beaten in the past, therefore I'm just going to buy a call option and expect the stock to do well. Let me give you two reasons for that, okay? And David has a good question. I'm going to address that question in one sec, but let me give you these two reasons why it's not as simple as that. Number one, when a company just kind of traditionally beats, there's an expectation, the expectations are they're likely to beat again in the future. So the market kind of prices that in. That's one reason. Another reason is, and a lot of you have experienced this, when a company comes out with earnings, have you seen this where a company the numbers look good and the stock goes down? It seems like, the top line, the bottom line look good and the stock tanks because very often what determines the stock price movement isn't just the bottom line earnings number. It's like a forecast, a projection of the future numbers. Guidance is what we call it. And that it's not as simple as just kind of looking and saying, oh, it's beating, it's going to do well this time. All right. So those are some good numbers, I think, to look at on this. But question in the chat was, David, great question, said, look, you talk about implied volatility all the time, Brent. What about what's this historical volatility? So implied volatility, when we talk about implied volatility, first of all, this is going to be an average implied volatility for the options on the stock. Okay, average implied volatility for the options on the stock. It is expectations of future movement in those options. Okay, and so the more expectation of future movements, the higher the prices, the more expensive they are. But what about this historical volatility? This actually is not on the options. This is on the stock itself, and it's looking not at future, but at past. Here it's the yellow. So here, going into earnings, the stock hasn't moved as much. After earnings, what happens? The stock moves a lot, so that volatility of that stock goes up. So the implied volatility is more forward-looking. The historical volatility is backward-looking there. That's one reason, and the implied volatility directly impacts those option prices. That's one reason we focus a lot more on that IV than that we do the historical volatility. But it's a great question, and I'm glad you asked that there. Okay, when I say top line, I mean revenue or sales. When I say bottom line, I mean earnings. Okay, earnings is the bottom line. Okay, let's move on. So we mentioned the straddle price. If I look at this stock, and let's just look at Meta here for a sec, and I'm looking out past earnings. Now, earnings, what was our earnings date here? Earnings, the 29th, okay? I picked that because they're coming up with earnings. Now, this is options that expire today. This is next week's. One thing you can do to try and anticipate the move is see what the market's kind of pricing in the move. One way to do that is to go, oh, look, they got 69% volatility here. But this number right here gives me about a plus or minus, it says $49 expected move between now and whatever date I have here. Okay, $49. Now you go, that's big. That is big. But it's an expensive stock too. It's a $644 stock. So you could expect, the market is pricing in, essentially, if I took this price, $644, subtracted $49, I'd come up with what I'd come up with. I'd come up with $595, I think, if I'm doing my math right. $595 on the downside, and on the upside, we'll say 50 plus $695, okay? $695. So this would be kind of basically a one standard deviation expectation of the move there, okay? Of where the range of the stock is priced in. So if you think the stock is going to go outside those ranges, then maybe you would consider a particular trade I'm about to talk about, which is a long straddle. If you think the stock is likely to stay within those ranges between now and expiration, which is really the day before, I think, this date right here, then you may consider, now I'm not recommending it as a strategy because there's risks on these strategies as well as potential rewards, but you may consider something like a short straddle. Now, let me just be upfront and clear about this. Most of you listening to me right now are not going to be approved in your options account for a short straddle, okay? I want to talk about it anyways because there's little variations on it that we can do that more of you may be approved on, but that would be like a Schwab level 3 option approval, a short straddle. So there are more risks on that, but we'll talk about that in a little bit more in there as well. Chris said in the chat, you can use average true range. You can use ATR, but just keep in mind, let's see, ATR is historical volatility. So looking at that around spikes should be helpful. Okay, so Chris is looking at ATR as a possible way of looking at past. Yeah, ATR, average true range, is backward looking at volatility. But keep in mind, it's a different story when we hit earnings. Things go up. Let's see. Okay, so. Okay, you're full of good questions, everybody. This is David's question, and I may not address everybody's questions, but because I just for the flow of things, but this is one that I know a lot of you have. Why does this number go down in the future? This is the implied volatility percentage, and why does the dollar value go up in the future? Well, let's think about the dollar value first, because I think that's the easier one. Think about where if our stock is here and we think about the possibilities, the ranges it could go between now and 7 days from now, there's a certain range. It can go up a certain amount, it can go down a certain amount between now and 7 days from now. Well, think about between now and 14 days from now. There's more time for it to drift even further. And therefore, there's a bigger range there as you add more time onto the equation. That's why as you go further out, those numbers will always go up. Okay. Implied volatilities are going to be highest by the contract that is going to be most impacted by the options. And the one that's going to be most impacted by the option, the prices that are going to be most, not by the options, by the earnings, the IVs that are going to be most impacted by the earnings are the ones that are closest to those. Now, these will still be impacted a little bit, but typically what you see is these IVs right here, the 68, is probably going to get a lot closer to these further out in the future. In fact, if you're wondering when earnings is, one way to kind of think about it is, an easy way, I showed you the exact way, but if you want a sense for when earnings is, look at when that IV spikes and then starts to go down. Now, look, we don't have earnings between now and then. This is when it spikes. So we know, or we have a good idea at least, that earnings is going to be between this expiration, which is today, and this expiration, which is there. Okay, let's move on, though, as we go forward here on this. So if I want to know how much we may see in terms of movement, one way is to look at this number. Another approach is to look at the money straddle price. That is the price of the at the money option. So we'll say 645, long put plus long call. I'm going to take the long call there. I'm going to take the long put here. I'm going to add those together. And what you'll notice is if you add that plus that, you're going to come up with a number that's pretty close to that. So sometimes when we talk about how much we are expecting and moving on earnings, we may use you may hear us refer to an at the money straddle. A long straddle, which is what we're talking about here, is you buy a call and you buy a put. You buy a call at the money, you buy a put at the money at the same time. All right, so let's talk about that. Then let's look at some example trades here. Okay, so let me go out of this, because I just want to kind of go through the math a little bit here on this. And so if I do, let's just do some numbers here. If I were to, I'm going to just make up a stock. I'm going to go away from meta here for 1 sec. Let's say we have, because I want to keep the math nice and simple for us. I'm going to say we have $100 strike price. Okay, and the stock is, we'll say, about $100. Okay, because we're doing the at the money strike. Okay, I do a long call, and we're going to say that costs us $3. Okay, and at the same time, I do a long put. So this is a straddle. This is a long straddle, and that costs $3 too. Again, I'm keeping the math easy. Obviously, I want to be exactly that probably. So total, we've got how much? A $6 debit on this. Okay, $6 total debit on that. how much movement do we need on the stock? Where's our break evens in terms of the stock price movement? Remember, the stock's at 100. The answer is, well, if the stock goes up to 106, that would be a break even. BE, break even. Okay. If the stock goes to 94, that would be a break even. Why is that? Do you guys see why that would be? Well, here's what I'm doing. I'm just taking the strike price and I'm adding the debit and I'm subtracting the debit. Adding the debit, I come up with 106. Subtracting the debit, I come to 94. Those are my break-even points on that. If I think the stock is going to move more than that, outside that range, then it may make sense to do that long straddle. If I think the stock is going to move less than that, then we'll get to the short straddle in just a little bit here. But let me move on with this, okay? How does that work out? Well, look, it's costing me $6, so I need at least the end value to be at least $6 to make up for my initial debit. Well, if the stock goes to 106, what's the call option going to be? Well, it's going to be the amount that it's in the money, the intrinsic value of it, which would be $6. 106 minus 100 is the $6 intrinsic value. That would be $6 in the money. So there's your break even on that side. What's the put going to be? Well, if the stock goes up to 106, the put is going to be worthless, close to it, roughly, we'll say, roughly worthless. Okay, so that's why that works. What about the break even on the bottom? Well, if the stock goes down to 94, how much is the call going to be worth? Probably about zero. How much is the put going to be worth? The intrinsic value. If the stock's 100 and the stock goes, if the strike is 100 and the stock goes down to 94, then we're going to have about $6 of intrinsic value on that. So that's how those break evens work. So let's move on to the next step here. If you think, so in terms of our stock, okay, so remember what we said here on this one on Meta, we said roughly $50. I'm going to go to roughly $50 here on this. It's $49.37, but just to make the math easy here on this. So if I take 645, add 50, we're up to 695. Let me draw a line where the 695 is here, okay? This isn't going to be exact, but we're going to call that good. If I take $50, we said about $595. So you can kind of do this. Excuse me. You can kind of do this. Draw those lines. Well, you can draw those lines on there if you want to try and help visualize where you think, where the stock should be. So let's do this, but let's use a different stock example here. Okay, I'm going to use Caterpillar. This was another one on our list here. Here's Caterpillar. Caterpillar has had a pretty good run lately. Okay, run up, and my assumption is excuse me, I had a little frog in my throat there. I'm better now. My assumption is Caterpillar's had this big run, and I do have maybe a support level down here, but if we drop, it may, we can go a long ways down if we have a reversal of fortunes. We got earnings coming out on, I think, Thursday, if I'm not mistaken on that. Okay. And we're already at a resistance, so we're breaking through that and going up. Now, big caveat here on this. The caveat is whatever your technical analysis says, of course, technical analysis is never guaranteed of what the future is going to be. But whatever your technical analysis says can absolutely change when an earnings comes out. A lot of you have seen that. A lot of you have been in stocks that have had a nice upward trend and they've had earnings and that trend got demolished right there. So it's certainly no guarantee. But, if you're trying to decide where we may go, you may look at things like technical analysis here. Let's see what kind of movement we have on Caterpillar. And let me just mention one other thing while I got on this. Sometimes you may see a little thing up here that says MMM, market maker move. And that's only going to show if your IV here is the higher IV than what you have here. Because I have earnings expiration today, these IVs, not earnings expirations, because I have options expiration today, these IVs are lower here. So we're not showing that number. But what you're going to find is that number is usually going to be not that far off this number. This number right now is about plus or minus $19. So let's take a look at plus or minus $19 on that graph. Plus or minus 19. Okay. Caterpillar, where's our stock? $19 plus 408 is going to be 427, which is going to be about here. Let me draw a little line here. 427. Okay. $19 minus 408 is going to be about 390. Okay. Roughly here. 390. That's what the market is pricing in terms of our potential range here. So let me, in fact, I'll make it a little bit, maybe. Come on. That's kind of the range that's priced in. If we think it's going to move outside that, then we could do a long straddle. Why did I explain? Why $19? Thea's saying 19. Remember, I looked right here in terms of our expected move. This is the expected move based. It's not a guaranteed move. Notice I didn't say guaranteed, or I didn't say it's going to move $19. What I said is this is what, based on the implied volatility, what the probable move is based on that. But, you know, probabilities, who knows what that means. That's how we came up with that. So how do we do the trade? Well, let's do it. Let me go here. I'm going to go to my, let's go to analog. Well, we'll go to trade tab. Okay. I'm going to go out. I need to go past earnings, which we have. This is past earnings. Remember, earnings is Caterpillar the 30th. So that would be on the morning of the 30th. And here's the 31st. Okay. Well, that may not be morning. It could be evening. It could be after a market on the 30th too. I'm not sure. But certainly on the 31st, we will be past earnings. So I'm going to do this. Now we can enter the trade now. Now you could enter it Monday or Tuesday or Wednesday or something if you wanted to, but today is when our class is. So we're going to enter it now. And we're also going to do this. We're going to buy, we're going to sell, we're going to plan on selling when this comes out. Hopefully the stock moves up a lot or moves down a lot. This is not a directional trade per se, because we don't care if it goes up or down. This is a volatility trade. We just wanted to move a lot on this. Now, Agariba said Vega is going to change things. Remember, we talked about that implied volatility and how that's going to lower. But keep in mind, those break evens are based off of our, when I talked about break even earlier, that's based off of our intrinsic value. The intrinsic value does not change. The extrinsic value does change, and it will change quite a bit. But that intrinsic value does not change. So, I mean, the intrinsic value, let me repeat that because that didn't come out right. The intrinsic value may change depending on what the stock does, but the price is not dependent, or break-evens are not dependent, that we're calculating are not dependent on the intrinsic value, on the extrinsic value. They're dependent on the intrinsic value. Okay, I kind of didn't say that very eloquently, did I? Let me try it one more time. Our calculated break-even prices do not depend on our extrinsic value. They depend on our intrinsic value. And the extrinsic value is the portion that is dependent on that Vega or that implied volatility. Okay? All right. Let's do it. What's at the money? 407 is the stock. Well, 407.5 is the closest we're going to get to that. I'm going to buy the put. I'm going to hold down my control key and buy the call. Okay, I've got both call and put together. 18.7 is our debit. Okay, we said $19 earlier, close enough. That's the trade right there. Now, come Friday morning, it's very likely the stock will move a lot. Hopefully it moves a lot, and not just quite a bit. If it moves a lot, then, beyond our break evens, then either the upside or the downside, this will probably turn out pretty well. And if it doesn't move much, if it goes up and comes back down, sometimes you see that after hours, it looks like a great move, and by the next morning, it's back down to normal. But very likely what will happen is the call will have made money and the put will have lost money, or vice versa. The put will have made money and the call will have lost money. Almost always you will have made money on one and lost money on the other. Which that's going to be, I don't know which that's going to be. But if you exit, just realize that's, we're going to probably get out fairly soon. Hopefully there'll still be some implied volatility hanging around, some higher implied volatilities hanging around. It'll take the biggest chunk out come right after earnings. But if there's still some elevated IV levels, that may help us out a little bit too on that. But there we go. Realize one of those sides is probably going to be almost worthless. And if it truly is worthless or right next to worthless, then you may not even decide to get out of that one leg. You just get out of the one that's making money. Okay, so what I'm going to do is I'm going to confirm and send. And I'm going to actually, I'm just going to edit this. I'm going to move it up. We'll move it right to $19 there, okay? See if we can get filled, confirm and send. And I'm going to put this in we'll just leave it generic. And I'm going to send that order. There we go. Okay, so that's the order. What does this look like on, the Analyze tab? Analyze, what am I doing? Let me just go to Analyze, Caterpillar. Let's go to Risk Profile. That's what it looks like, okay? See this? This is just another way of looking at that. Here's my break even. Oh, that's not my break even, never mind. Let me readjust this here. Current date is there. Expiration is, we'll put February 1st, the day after. And let me set my slices to break even. Voila, there's my break evens. 388.69 and 426. Those are my break evens there, okay? All right, so there we go. That's the trend. We want that move. That's a way of taking advantage of the bigger move. Now, let's say we're looking at a stock, and let's look at a different stock here. Okay, let's look at a different stock, and let's look at another one that has earnings. And this is a company that you're familiar with, Apple. And here's Apple. We're going to look at Apple. Apple has had some rough times. Apple is the worst performer. I tweeted or X'd on this, I don't know what you say, earlier today, actually. Apple is the worst performing stock in the Dow this year. In 2025, it's the worst performing stock in the Dow. You can see, not surprising if you look at that. Maybe a little surprising going into the year. I'm not sure I would have called that, but hey, there you go. Here's our earnings on this. Here's potential resistance, potential support, maybe, who knows? Let's see what our market maker move on this is. Here's Apple going out. Interestingly, it is a little interesting that IV actually isn't that high on this. Let me just double check here. What was our earnings date? Earnings date January 30th. IV actually is not that elevated on this one compared to what we have for today's expiration or the week after. But About $11, right? 10.96. We're going to say $11 move here. Let's look at an $11 move on this. Stock is at 222, so that's going to be 233 and a half, we'll say. So let's do a little mark on here on our guide just to get it visual. 233 and a half, call that close enough. And 222 is going to be about 211 and a half. Right? Keep it on the screen here. That's just right off the bottom of the screen there, okay? Let me just adjust this just a little bit. We'll activate that. We'll move this down to 11 and a half. Okay. So this is the range. Okay. This is the range that we're looking at. Now, if our expectation is it's not going to move outside that range, okay? If our expectation is it's not going to move outside that range, then maybe we consider a short straddle. And I'll talk to you about that in just one sec. Okay. So Anthony's a good question. And Anthony has like a really tough question as well, because how do you know if it's going to move? And Anthony didn't say, did you know? Of course, you never know. But what are some factors you may consider there? Well, you can look at past moves. I mentioned that. You can look at other factors you know about the company. Maybe there's something in that company that you think is going to lead it to, is going to be more volatile that's coming out, and some fundamental factors or something. Maybe in the news, something. Or you can use technical analysis. Like I said, you never know on the technical analysis front. But in this case, I'm kind of saying, well, I've got some resistance here, and I've got some support here. It's a little outside the range, I guess, but we're kind of in that ballpark. You can use technical factors as well. Those are the main things that I can think of. Looking at past moves, looking at news, looking at technical analysis. You can use other indicators such as this. And David pointed out, yeah, Brent, your break even down here is actually below your support level. It is. It's not that far below, but it is a little bit below. So if that, I figure, look, if I really think it's going to move down here, then that would be a factor not to do this trade here. Okay. All right. So what if we were to sell to a short straddle here? Here's the thing with short straddles. Well, let's do one, and then we may play with it a little bit here. So I'm going to do the same thing. I'm going to go just after expiration. You don't have to go months out. You don't have to go weeks out. You can go as long as you're past expiration, you're good. Our current stock is about 222 and a half. So I'm going to sell my put. I'm going to sell my call. Hold down my control key. Let's just do this. About $10 credit. I was saying 11 before, so our break even's a little bit more beneficial to us than it was otherwise. But let me confirm and send. I'm not going to send it right away because I want to point out to something to you. And this right here is why most of you aren't going to be approved for this strategy, a short straddle. Unlike the long straddle, where you have a defined risk. What's the risk on the long straddle? What you pay for it. That's the risk on that long straddle. What's the risk on the short straddle? Infinite. It's unlimited. That's problematic here. So if you're going to do this, if you're approved for it, and you're aware of the risk, and you're comfortable with that, you're likely going to put in exit points on this trade. Okay? You're going to likely put in exit points on this. Stop losses, in other words. Okay. There's another choice though. Okay. And that is why this is why I don't typically teach short straddles. It's why I typically don't just teach naked calls. Instead, what we often do are spreads. Okay. So in this case, if we have a short call and a short put. Now, technically, the short call is giving us that unlimited risk. The short put has a theoretical limited risk, but it's a huge limited risk. But what people will do is they will go and they'll say, well, what if we kind of protect it and do a long call out here and a long put below it? Then what do we have? Well, actually, this short call and this short put are the same strike, aren't they? So I'll put them kind of on the same level in this because this is a short straddle. Well, we have an iron condor, or in this case, technically, if these two are the same, what we call an iron butterfly, but same point basically here on this. As Harry said, iron condor. That's how you can limit your risk on that. Now, I have a bunch of iron condors, and we do these quite often in this class. And so I'm going to, I'm not going to do that this time. I'm actually going to do the full shebang here. I'm going to do not the iron condor. I'm actually going to do that short straddle. I'm going to put in a closing order here on this though, to get us out if the stock moves too far. So I'm going to do a first sequential trade. I'm going to right click on this. I'm going to create an opposite order. Now, at the risk of belaboring the point, if you try and do this, most of you aren't going to be able to do this in the account. But if you want iron condors, I do teach iron condors all the time in this class. You can see that. This one, if you're going to do this, what I'm going to do is I'm going to put in an exit point on this. I'm going to make that a market, good till cancel. This doesn't guarantee we're going to get out, right? But I'm going to say, look, if we break above, I'm going to say 240. If I break below, we'll say 210. I'm going to get out of this trade. I'm going to click on my gear. Mark, less than or equal to 210. Mark, greater than or equal to 240. Now, what if Apple jumps up to $300 overnight? Are we going to get out at that 240 level I just put in? Probably not. No. That would be a huge loss. Now, it's not an unlimited loss. I mean, the reality is Apple's probably not going to go up to infinity. So the unlimited loss is, can be daunting, but there is significant risk in that. And I just want you to make sure that risk is very apparent to you. That's why we say it's an unlimited loss. Now, if implied volatility drops a lot, that's going to tend to benefit this trade. So I'm going to confirm and send. I'm going to send that. It's thinking. It hasn't filled yet. Let's look at our risk profile on that. Let me just check time. I do need to wrap up here soon. Let me go to my simulated. Oh, it's not filled. Okay, so it's in limbo because it's not filled and it's not a simulated trade. So let me go and I'm going to cancel and replace this. Oh, come on. Well, I'll tell you what. I'm out of time. Let me just kind of tell you what this is going to look like. Let me kind of show you. This isn't going to be precise, obviously, but it's going to look like this. Our gain is going to be here on this. We'll peek out at a gain if the stock doesn't move. We'll cross through our break even, and the loss gets bigger and bigger the more it goes down. The loss goes bigger and bigger the more that goes up. That's where the risk is on this. All right. So just to summarize, this trade here, and I do need to finish up with this. This trade, if I fill this and the price was about $10 on that, if the stock, the less those are worth, the better. If Apple stays right where it's at and both the put and the call lose almost all their value, I'd get to keep that, the biggest part of that. This is one you're going to want to close out. Remember, short options can be assigned early. So this is one you want to keep an eye on. After expiration, we look to close out right away. All right, everybody, thank you very much for joining me today. Thanks, Barb, for helping me on the chat. Make sure you subscribe to the Trader Talks channel, and we will see you all same time next week. Bye-bye, everybody.